Folks, we've got lots to talk about today. Number one, we need to discuss the latest on plays, including our UCAR play, which made a new cycle high this morning, and our latest top idea, UUU, which ran some 72.5% from original alert price. Is more coming? I will present the setup. And number two, we need to discuss the market. Specifically, what the big money is doing right now. Markets are in yet another day of skyrocketing, and we'll break down what is going on beneath the surface. We'll get to work in a second, and I'll put all the timestamps down below. And today's video is brought to you by our Memorial 50 coupon code, which will get you 50% off ZipTrader U membership. You'll get access to our step-by-step lessons, private chat, and very popular daily morning briefings. The sale ends Sunday night. Make sure to take advantage of that if you haven't already. Okay, so let's go ahead and start with play. So context, UCAR is a stock that we briefed on at $5.13 a share yesterday morning on a partnership/cooperation agreement catalyst, and it ran to $11.30 at highs and then $15.29 at highs today. That's a 198% run briefing price to highs day over day, and then it sold off a few hours after open and broke back down below our red directional. So what is the lesson here? Well, stocks can run big, really big on catalysts, but they don't hold their runs, right? You need clear criteria that allow you to manage your risk. That could be a 5 to 10 to 15% down stop loss. That could be something more broad, like a break of direction below our red directional SMA line or break below our price strength SMA line for those who are scalping minute by minute moves. Whatever it is, you must know that catalysts can run, but they never run forever. But anyways, we broke down this catalyst in yesterday's video, and this is indeed a big deal for UCAR and will likely provide rolling catalyst moving forward. I'm specifically excited about their mention of recruiting other partners in the field. This is a big deal, and I imagine each partnership press release could have a somewhat similar run to what we saw today and yesterday, and I'm all for it. In terms of this current cycle of momentum, though, I'd say let it die and see where it finds support. If it can break back above our red directional and hold there into open Monday, I wouldn't be surprised to see another new cycle high, but overall, I'd say the clock is ticking. You want to see this momentum cycle get really tested because that's the only way it's going to continue. MMV was another fun play this morning. We briefed on this bad girl at roughly $2.06 a share, and it proceeded to run to $4. That's a run of about 94% briefing price to highs, but why, Charlie, did we brief on it? Well, they signed a term sheet. Quote, Multi-Metaverse signs non-binding term sheet with Taomi Group for equity stake acquisition. Now, term sheets are preliminary deals. It's basically like saying, hey, we've begun negotiations. But the reason that markets like this is because once you've begun negotiations, that means that you have all these other catalysts coming up in terms of getting to that finalization of the deal. But pay very close attention to what we are seeing here. A lot of stocks like this one will have catalysts that drop in the pre-market, and then they will run quite a lot in the pre-market, and then shortly after open, and then when markets slow down, the stock sees a massive dump towards the end of the session. So there are two big takeaways here if you're trying to trade these types of plays. Number one, you need to have a broker that allows you to trade in the pre-market and also the after hours, but especially the pre-market. Go on Google, get a good broker that allows you to trade in the pre-market and after hours. They get a lot of comments. They say, Charlie, nobody can trade in the pre-market and after hours. That's not true. You just need a broker that allows you to trade in those extended hours. Our recommended broker is Moomoo. We have a partnership arrangement with them. You get a bunch of free stocks, all that kind of good stuff. I don't care if you use them or not. Just find a broker that you really like. Find a broker that allows you to trade in these pre-market and after hour sessions. And the second takeaway here is you need to focus your efforts on the beginning of the trade, not on buy and holding the trade until retirement. If something is running on a catalyst, it's going to be very short term. So you have to get in and you got to get out. If you are somebody that buys and holds catalysts, you're going to have a bad time. It's that simple. Okay, next update, our top idea, triple U. We posted our latest top idea yesterday at 10:19 a.m. Charlie, California time at $193 a share. And since then, it's gone up to highs at $333. That's a run of about 72.5% alert price to highs. Very fun play that has been holding its overall direction very well. I am pretty pleased with it. In terms of moving forward, though, I am looking for a nice sell-off cycle that then allows it to retain. Why is retention so important? Because retention means, hey, it's sold off and it's still able to hold a level of support. There's still enough holders that are like, yeah, we're waiting for next round of momentum. And when you have that kind of foundation, it's really easy for higher and higher highs to be built on that momentum, to be built on that foundation. If this trade is going to continue and not conclude into the abyss, well, it needs to prove its worthiness, and the only way that it can do that is by seeing a nice take profit cycle that it then rebounds from. I'm expecting to see that on Monday. If it can fit that criteria, area, I'm confident that you'll see this continue to be a player into early next week. If it can't do that, I'm confident that it won't be a player. Okay, moving on to the market. So we are in yet another day where markets are just skyrocketing and well on their way to breaking the next bear market peak from August 2022. Is this going to keep going? Well, we showed the data earlier this week on how the first 100 trading days for the S&P 500 are historically very indicative for where the markets are going to end the year. On years where the first 100 trading days were up 8% or more like this year, you'd average 25% in returns on the full year. And there was really only one year, 1987, that was a huge exception to that, and a lot of its returns were more front-loaded at that point, and that's the year of Black Monday. So will this trend continue? Well, it's worth mentioning that a lot of this is being driven by just the top 5 companies. You look at the average return of the 5 largest S&P 500 companies, they are at 56.2%. You look at the rest of the S&P 500, the average, it's at 8.9%. This is dated ending May 31st, so numbers are a little higher now, but still, bigger picture, this is what we are looking at. A market that has been bad for most companies, but great for tech companies. And why is that? Well, Bank of America thinks that this is due to Federal Reserve bets, hopeful tech immunity in a recession, and AI. This is what they said according to the Berg of Bloom. Quote, monopolistic tech is winning through pricing power and the squeeze on smaller suppliers, Hartnett wrote in a note, highlighting the NASDAQ 100 index is now at a record high relative to the Russell 2000 small cap index. Tech stocks have surged 32% this year on wagers the Federal Reserve will stop raising rates and that the sector will be more immune to an expected recession. Optimism around AI-related stocks gave tech an additional boost in May, briefly sending Nvidia's market capitalization to $1 trillion, while Apple Inc. is back near record highs. And the contrast between what funds were doing earlier this year and what they're doing now is pretty stark, pretty Tony Stark. Weekly equity inflows have turned extremely positive, and then you look at the jobs report today. Monthly jobs grew. You had a huge uptick in hiring in professional/business, education and health, leisure and hospitality and education and government. At the same time, the unemployment rate ticked up just a little bit and average hourly pay dipped a little bit. And surprisingly, markets are happy about it. Usually markets hate it when we get good economic news because that means more aggressive Fed policy. But right now we are in a cycle where markets just don't care. And part of that might be because trueflation numbers have tanked quite a lot. And it's expected that the next report will show a big drop in inflation. But at the same time, I mean, a lot of Americans think that inflation is going to rise again very, very soon. So how long is this market rally going to last? Well, 10-year treasuries are picking up once again pretty consistently so far the last couple of days, the first couple of days of June, and bond markets are trying to price in the chance that the Fed perhaps gets a lot more aggressive. And again, 78% of Americans think inflation will rise again if the Fed decides to be a little bit more easy, a little bit more dovish now. That is almost going to be a guarantee. And expectations help drive the Fed's decision making, so that could be something in favor of a more aggressive hike. And if they do decide to get more aggressive and more hawkish, that would be something that would kill this rally immediately. But for now, markets are calm. They aren't scared. They're not scared little salamanders about the economy, and they aren't scared of the Fed. They just want to make money. And I say, let them make money, let them rally, let them provide tons and tons of opportunities. And when the Fed decides to adjust their policy stance again, whether too early or too late, well, we'll have to take advantage of the downturn as well. Have an excellent weekend, and make sure to take advantage of our 50% off sale on ZipTrader U, coupon code Memorial50, which expires at the end of this week on Sunday night at midnight. Have a good one, folks.